Welcome, everyone, and welcome to Policy at McCombs, our first session in 2019. We're happy to have today Professor Larry Brown from Johns Hopkins University.
Larry Ball.
Larry Ball.
Yeah.
No, I said Larry Ball. Sorry, that was my.
Just get the book title right.
Exactly.
Get the book title right. And the Amazon page.
Exactly.
Yeah.
So Larry is going to be telling us about his work on research on the financial crisis and the events surrounding the Lehman Brothers bankruptcy. We're going to start with a few comments by him, presenting a little bit of the argument, and we're going to have some questions like we typically do, and then open to the floor so you can ask your own questions as well. We're joined today by Professor Richard Lowry as well from the Finance Department. Richard does work on financial regulations to some extent, and so should know a little bit about this. I don't know anything about this. I'm a statistician, as you all know. And also joined by Professor Mario Villarreal Diaz, that's joining the CIPA as of 2 weeks ago. So he's a political economist that's helping us with the center. So you see a lot of these two faces and me and in our events going forward. Anyway, so with that, I'll bring up your slides here, so that's where we're going to start, right?
Yes.
Okay.
Okay. Well, thank you very much. I'm very happy to be here. Looking forward to the discussion. And we decided it might be helpful to give a brief background on the financial crisis. So the book is about the Lehman Brothers failure, and the main point is that the Fed could have and should have rescued Lehman Brothers, and then the whole financial crisis and Great Recession would probably not have been as bad. So that's that's the takeaway. But before getting into that, it's interesting for me, and maybe some of these people, given my age and interests, this is very recent history seared into my memory day by day in 2008. But maybe for some of you, we decided just a little background on the crisis, the financial crisis in general, and then just a little bit on what my book is about, and then open it up for whatever. So, background on the financial crisis. And I've thought quite a bit about how to summarize this episode concisely, and here's my effort. A lot of big financial institutions on Wall Street got in trouble and failed or almost failed and had to be rescued by the Federal Reserve and the government. So how did that happen? So specifically, I focus here on the big five investment banks as of 2008, Goldman Sachs, Morgan Stanley, Merrill Lynch, Lehman Brothers, and Bear Stearns. They were in many ways similar institutions with similar business models, and they all got in trouble over the course of 2008 and had threats to their survival. And there were very different outcomes for what happened to the five of them, but that was mainly because of how the government and the Federal Reserve treated them as opposed to how big their underlying problems were. So what were their problems? So like a lot of things in life, like mistakes we all make, it's possible to look back and think, that was obviously not smart. What in the world was I thinking doing that in hindsight? In hindsight, it's pretty clear how all these institutions, not just Lehman, got themselves in trouble. The first is that they all got, in the first decade of the 2000s, very enthusiastic about real estate investments. Real estate prices were going way up. So they all originated mortgages, bought mortgages, funded commercial real estate projects, securitized mortgages. And for a while, they made a lot of money doing that. But when the housing bubble started deflating around 2006, they started losing money. So that was problem number one. Problem number two is that they all operated with a high degree of leverage, or with a low level of assets relative to capital. So, we've talked about trying to not speak in jargon. It's, say Lehman Brothers had $100 of assets, that they financed that with $4 of their own money and borrowing $96. And again, that was true. The numbers were around 3 to 5% for all the big investment banks. And if you have $100 of assets, but really only $3 of it or $4 is your own money, you don't have to lose very much of the value of your assets before your equity gets to zero or gets close to zero. So the losses in real estate led very quickly to fears that the investment banks don't have low equity, they maybe have zero equity or negative equity. Maybe they're not solvent, maybe they're not going to survive. And then the third and final thing that played into this is that their business model involved holding risky illiquid assets like various real estate projects, but raising funds by very short-term borrowing, often literally overnight borrowing, which they had to roll over repeatedly. So every day they had to get their lenders to agree to roll over the loans. And that was a recipe for trouble, because it meant once they started losing money on real estate, and once people started thinking, these institutions might not survive, the next thought was maybe it's not so smart to lend to these institutions. And their lenders could cut off lending in many cases literally within a day. So both Bear Stearns and Lehman Brothers, the crisis, the height of the crisis was really an episode of 2 or 3 days when suddenly all their funding was cut off. So in economics terms, this is basically a modern version of a bank run. So everybody still watches It's a Wonderful Life, right? If you Google It's a Wonderful Life bank run. So there's a rumor about Jimmy Stewart's bank, and everybody thinks there's something wrong with it. So they all line up to withdraw their money, and the bank's going to go under because it doesn't have any money. And actually, in that case, Jimmy Stewart explains to everybody, this is how banks work. We don't have cash, we give out mortgages, there's nothing wrong, calm down. And Jimmy Stewart, being a very much loved, highly credible figure, reassures everybody and they don't withdraw their money. Actually, Richard Fuld at Lehman Brothers tried the same thing when his lenders were cutting off funding. He reassured them, we have a fundamentally strong business, there's no reason for you to be doing this, but it didn't work out so well. So Lehman Brothers declared bankruptcy very suddenly at 1:45 a.m. New York time on a Monday morning. And that's because on Friday afternoon, they had $1.4 billion in cash, which is roughly zero in this industry. And actually at 9 a.m. London time, 4 a.m. New York time, 3 a.m. Austin time, their London broker-dealer was supposed to pay somebody $4 billion. And they didn't have that, so they had to declare bankruptcy just because they didn't have cash to operate.
Let me ask you a question
Yes.
before, because I think it's relevant to this. Give us a sense of the percentage of short-term financing that they had at this point in time. So their assets were about $600 billion?
About $600 billion. They had on the order of $100 to $150 billion of these repurchase agreements, which are these short-term loans. And maybe half of those were literally overnight, something like that. So they could run out of a lot of money in a hurry. All right. And then again, I want to get to the discussion as soon as possible, but just to set the stage, again, this is, every date and every hour here is seared in my memory, but for more normal people, the first of the big investment banks that got in trouble was Bear Stearns. It actually was the first. It posted a loss in the first quarter of 2008, whereas it took until the second quarter of 2008 for Lehman Brothers to post a loss. So they were a little ahead of the curve in a bad way. And in March 2008, suddenly they had no cash. There was a big crisis. That was resolved by J.P. Morgan Chase purchasing Bear Stearns with the important requirement. J.P. Morgan Chase said, if we're going to purchase Bear Stearns, first they have to get rid of $40 billion of these real estate assets that we think are not really worth $40 billion. And that was accomplished by the Fed creating something called Maiden Lane LLC, which is basically a shell entity that was established just to purchase the $40 billion from Bear Stearns, so that then J.P. Morgan Chase would go through and buy Bear Stearns. Also, and this will be important for Lehman, in March, and this is probably not that well known, the Fed created something called the Primary Dealer Credit Facility. Primary dealer means the primary dealers in Treasury securities, the big financial institutions that buy and sell Treasury securities with the Federal Reserve. So it basically means the big global investment banks and commercial banks in New York, Citi, J.P. Morgan Chase, Goldman Sachs, Credit Suisse, and so on. And so this was something that would lend to primary dealers if they needed cash. And it was meant, so we should get to this at some point, this lending was a form called repurchase agreements, which is a little bit complex. Formally, it's a somewhat complicated seeming deal in which, say, Lehman, who wants to get cash, will sell a security with an agreement to buy it back the next day for a little bit of a markup. Long story short, in economics term, it basically amounts to a collateralized loan. There are legal reasons why it's structured as a repurchase agreement. Bear Stearns, the counterparties to repurchase agreements wouldn't roll them over. The idea of the primary dealer credit facility is now the Fed has this facility which will now do repurchase agreements. So if an investment bank can no longer, so the providers of cash were things like money market mutual funds or insurance companies. If they no longer will provide cash in repurchase agreements, now the PDCF will do that and will take the collateral, which previously was being taken by the private counterparties. And that was supposed to protect. And getting ahead of the story, one way to look at what the Fed could have done in the Lehman episode is just to allow Lehman to borrow from the PDCF in the way the PDCF was designed for 6 months later.
And let me make a point here that I think helps clarify what you're going to say later. What role was the Fed playing in those two decisions, deciding to create Maiden Lane as a new way to get those $30 billion of assets into its portfolio, and the creation of the? Why did they have to create this thing given their mandate? What was the part of their mandate they're trying to fulfill with those two choices?
We're talking about the lender of last resort?
Yeah.
Okay. Right, so going back to the 19th century and the work of Walter Bagehot and the whole rationale for setting up the Federal Reserve System in 1913, a key, or really the central function of a central bank, we now think of it as central bank sets interest rates and things, but so the classic function was to be the lender of last resort, meaning if there's a run on a bank, which, and so actually the background to that is that a big idea in economic theory, that the Diamond-Dybvig model is the big reference in the economics literature, the idea of a bank run being if depositor, again, and this applies to the Jimmy Stewart scene that you should all look up if you haven't seen it, if depositors decide they want to withdraw their money, that's enough to force a bank into failure, even if the bank really is perfectly healthy and there's no reason for the bank to fail. And so the central function of a central bank is for it to keep its cool in such circumstances and step in and replace. So again, for a classic bank, like replacing the cash lost in deposits, in this more modern version, replacing the short-term lending that repurchase agreement counterparties are no longer rolling over.
If the repurchase agreements were truly risk-free, why would I resist doing it? In other words, what am I losing by giving it to Bear Stearns? What were people concerned about?
Let's go back to that point. Let him go over the argument and the chronology, and we'll hold your question. I'll get back to you.
Because actually,
that's an important one.
That's a great question, right. The answer to which is a little puzzling. We discussed that this morning. All right. So September is when things explode. So September 7th, the government takes over Fannie Mae and Freddie Mac. And then again, Lehman, as of Tuesday, September 9th, still had $23 billion of cash. And it was really just over a period of 2 or 3 days that they lost all their cash. And it was clear they were not going to be able to open for business on Monday morning. So what are we going to do? So there are lots of books and movies. You've probably all seen some of them or read some of them about the big weekend at the New York Fed with all the negotiations, what's going to happen with the government and the different Wall Street executives. It's a very dramatic story. And as of Saturday night, September 13th, what was going to happen was that Barclays, the British bank, was going to acquire Lehman. Then on Sunday morning, September 14th, there was an unexpected, horrifying development. Barclays was a UK bank, so UK regulators had to approve it, and they raised some objections. And the details here are a little bit technical. There's controversy about why did the UK regulators do that, because they've done something different. But anyway, that was, so suddenly on Sunday afternoon, everybody realizes, oh my goodness, Barclays is not going to come to the rescue. Lehman has no cash. 9 a.m. tomorrow morning, what are we going to do? Also on that day, actually Bank of America had been thinking about acquiring Lehman. They found a better option. Actually, this is worth as far as the, so this is recounted in lots of these books and things. There were the meetings at the New York Fed about what are we going to do about this crisis. Bear Stearns was the fifth biggest investment bank. They'd had this run which had wiped them out of business. Lehman Brothers was the fourth biggest investment bank. There was a run going on that was about to wipe them out of business. Everybody talking about what are we going to do? One of the people in discussions was John Thain, the CEO of Merrill Lynch, which happened to be the third biggest investment bank. And he was a very smart guy. He thought to himself, well, if there's a run on the fifth biggest investment bank and then a run on the fourth, what happens after that? So he apparently walked out of the meeting and called up Kenneth Lewis and say, how'd you like to, buy the Thundering Herd for zero, or essentially. So that took them out as a bidder. But Lehman was not rescued. It filed a bankruptcy petition. And then again, we can get back to some of this. So Barney Frank, somewhat controversial figure, but he the former congressman, namesake of the Dodd-Frank Financial Reform Act, has a sort of sarcastic sense of humor. He actually said September 15th should be a national holiday called Free Markets Day, because on September 15th, Henry Paulson, the Treasury Secretary, said, well, we believe in free markets, so if Lehman fails, it fails, tough luck. And then on September 16th, they said, oh, well, just kidding, actually, we're going to rescue AIG. And we can discuss, I think actually they had reason to panic then, but. All right, so that's sort of the chronology. So then let me just seg you into just a very few minutes what this book is about. So my view is that the Lehman failure really was the pivotal event that caused strains in financial markets. I'm sorry, I forgot. Right. Well, yeah, I was going to say, well, yeah, this part is pretty. All sorts of bad stuff happened to the economy. Right. So and there's some controversy, but my view is that a lot of this flowed from the Lehman failure and the panic that followed that, and that if Lehman had not failed, that the whole financial crisis could have been quite a bit less severe. The whole Great Recession could have been less severe. A lot of people who lost their jobs and homes wouldn't have lost their jobs and homes. History could have been different in a better way. So. And then the last part is that then there were runs on the last two investment banks, Goldman Sachs and Morgan Stanley, but the Fed did for them what it would not do for Lehman, which was lend it lots and lots of cash through the primary dealer credit facility. All right, so the point of this book, so the big picture is there was this horrible recession. The horrible recession was caused by the financial crisis. The financial crisis was so bad because Lehman Brothers was rescued. Why wasn't Lehman Brothers rescued? So obviously they had problems, but Bear Stearns was rescued, AIG was rescued, everybody else was rescued. Why was Lehman different? So the Fed policymakers have given a very clear answer to this question. So I have quotes in the book, and they've continued. As recently as a couple of weeks ago, I listened with some irritation to a podcast with Ben Bernanke saying the same thing. So they have a very specific, well, I won't put the slide up, we can come back. They say, we knew it would be a disaster for Lehman to fail. We were as terrified as everybody else. We wanted to rescue them, but we could not do it because we did not have the legal authority. It would not have been legal. Why is that? Under the relevant law, Section 13.3 of the Federal Reserve Act, the Fed is allowed to lend to an investment bank like Lehman Brothers only if certain conditions are met. And a key condition is that there be satisfactory collateral for the loan. And what exactly satisfactory collateral means, what that term means, is somewhat subject to debate. But essentially, the Fed is not allowed to take on a significant amount of risk by lending to a bank and maybe not getting paid back. Because that ultimately would be costly for the taxpayers. So what Ben Bernanke and Tim Geithner, who was at the time president of the New York Fed before he was Treasury Secretary in the Obama administration, and other Fed officials have said again and again is Lehman was in such horrible shape. they didn't have nearly enough collateral. They had to borrow tens and tens of billions of dollars, and they didn't have anywhere near that level of assets. So it would have been futile to lend the money. They would have failed anyway. In any case, it would have been illegal to lend the money because they didn't have enough collateral. And Ben Bernanke said, I don't think the Federal Reserve should break the law. So, with great sadness and realizing a disaster would come, he said, I realized Lehman had to fail. All right, so my book says, why did the Fed let Lehman fail? And the main conclusion is a negative one, which is that the reason the Fed let Lehman fail is not the reason the Fed policymakers say. And again, just very, very briefly, we can come back to whatever details. I spent, so there's a lot of evidence on this from a couple of investigations of the bankruptcy that had subpoena power. So you can get very detailed information about Lehman's finances, and also, for that matter, the emails that Fed officials were sending back and forth to each other before the bankruptcy. And so two things are clear. One thing is that the officials who were talking about should we rescue Lehman, they were talking about various economic and political consequences of different courses of action. Well, if we don't rescue Lehman, what will that do to Wall Street? What will that do to the economy? What are the risks? Maybe we better rescue them. On the other hand, what will Nancy Pelosi do to us? If what kind of political criticism will we get if we don't rescue them? It was back and forth, and they did not discuss, is it legal? Does Lehman have enough collateral? That was just the issue of, did they have enough collateral? Was it legal? That was something they dreamed up after the bankruptcy and explaining why they didn't rescue them. That's point number one. Point number two, which is related but distinct, is even though the Fed did not assess, does Lehman have enough collateral, they could have done it, and we can do it now because of so much information. And to make a very long story short, after a bunch of calculations, I estimate, okay, there we go. Lehman needed to borrow about $84 billion to stay afloat. And, that's might sound like a lot of money to you and me. AIG borrowed $85 billion the first time, plus tens of billions after that. Morgan Stanley eventually got $109 billion from the primary dealer credit facility. So that, they needed sort of a pretty run-of-the-mill level of liquidity support by the day's standards. And they had at least $114 billion of assets, which qualified as collateral for the primary dealer credit facility. So even with very generous, haircuts or safety margins, there was enough cash. And that's just through the PDCF. They could have adopted a new resolution to broaden the collateral. Anyway, so if you actually look at it, it's very clear they could have rescued them. So why didn't they rescue them? Here, what I have to say is not really original. I think the number one question is it was political. That Henry Paulson, the Treasury Secretary, was the one who was telling the Fed what to do. And he's widely quoted as saying, I can't do it again, meaning another rescue like Bear Stearns and Fannie Mae and Freddie Mac. I don't want to be Mr. Bailout. I mean, he's literally quoted as saying, Nancy Pelosi will kill me, Congress will kill me. So that's not very original. I said this morning too. One reaction I've gotten from the book, which is not my favorite, is some people have said, "Oh, you found out it was all political to let Lehman fail. So you spent how many years and how long is your book? Maybe your next research project should be, is pro wrestling fixed or not? You could write a 200-page. So some people think it's obvious, but again, the Fed has said no. That's a misunderstanding. So in addition, it's clear that the Fed did not fully anticipate how costly the bankruptcy would be. And again, there's been some revisionist history. Bernanke and others now say we knew it would be a disaster. Of course, nobody would want to let that happen. But if you read things, you can literally read lots of things that Fed policymakers were saying and writing to each other on September 15th, September 16th. And they were saying, well, gee, there's some strains in financial markets. We better keep our eyes on this. We don't want to do anything rash like cut interest rates before we know this is really a big deal or not. But certainly if they had known what was going to happen to the economy, maybe they would have done something different. And let me just stop there and go in whatever direction people.
All right, so you want to start?
So, I would just jump in on where you were ending up. So your book sort of goes through and collects a lot of information about what their collateral pool is. Could you address a little bit to what extent is that what you could figure out now versus what you could figure out they could figure out then? Do we know? Because I've heard a version of the story from a off the record. The insider was just like, well, they just kept everything on legal pads, so we didn't have any idea what their collateral was. Is that a credible statement for them to make, or?
Not really, because they didn't, so this is a slide I didn't go through, they didn't even have to know the collateral in advance. All they had to do was say, the primary dealer credit facility is open for business. If you have collateral, bring it to us and we'll lend against it. So another whole part of the story we went through this morning was that they put limits on how much Lehman was allowed to borrow from the PDCF. So really, all they had to do was say, if you have the collateral, we'll lend against it.
So the other question that comes up is this question of the institutional arrangement that Henry Paulson comes up as somebody making a decision that by law he's not allowed to make, is not allowed to even participate on. So I guess one of the points that people might not appreciate as much is that the fact that perhaps now we celebrate those three guys in the room trying to figure this out and trying to find a solution to this big crisis, it's more like a technical question that the Federal Reserve should be addressing on a question of whether to lend to somebody or not, that the sole authority of that was in the hands of the Federal Reserve. And somehow that got co-opted by the political process, which the Federal Reserve should not be a political actor, right? So
that's a fascinating part of the story, right? So the classic theory of the lender of last resort says the central bank should be the lender of last resort, not the government. And the Federal Reserve Act says the Federal Reserve can decide whether the Federal Reserve lends. I mean, there's a procedure in which the Federal Reserve Bank of New York can ask the Board of Governors of the Federal Reserve in Washington to approve a loan, and the Board of Governors votes on it. The role of the Treasury Secretary in that process is exactly the same as the role of the Secretary of Agriculture. It's exactly the same as the role of the mayor of Austin, Texas. It's not supposed to be any of his business. Now, what happened in this episode was, the basic facts are Henry Paulson got on an airplane and went to New York and went to the New York Fed and started telling Tim Geithner, the president of the New York Fed, what to do, and Tim Geithner did what Henry Paulson said. And Henry Paulson made the decision. At some point, Henry Paulson said words, very closely approximated by Lehman has to declare bankruptcy. So then there's a question of why did they defer to Henry Paulson? And maybe I won't even say anything about that right now, unless the best
in the book.
It's in the right, you got it. The best I can do is just sort of force of personalities. That Henry Paulson was the kind of person who, over his career, was used to going into rooms and telling people what to do. And if they didn't do it the first time, he said it louder and with. Actually, if you read Andrew Ross Sorkin's book, these guys really used, inappropriate for the office language in talking about these things. And Geithner and Bernanke, just for whatever reason, didn't resist that. Geithner could have, told Paulson, we're going to have the security guards of the New York Fed escort you out of the building, but he didn't do that for whatever reason.
If I may, just to see if the other end of the spectrum is also interesting for students here, particularly because at some point, if not already, you guys are going to be operating in a business that is going to be under some sort of regulation, right? Larry, after the aftermath of all this was terrible and with a very high and dramatic economic cost. So there was a response, right? We need to regulate this so it doesn't happen again, or if it happens again, authorities have the instruments to limit the extent of the damage. Now, but at the same time, regulation, as you guys know, may also limit the ability of an industry to operate properly and to create the value that it's supposed to create. So my question to you will be, a general question would be how do you see balancing those two things in general? And specifically, do you see that the resulting regulation, particularly Dodd-Frank, but not only that, you talk about that in the book, serves a good purpose in balancing those two aspects of a regulation environment?
Okay, so that's a great question, of course, and we just discussed this before. I mean, there are two parts of policy towards crises. There's trying your best to prevent it, and then there's given that you're never going to be perfect doing that, dealing with one if it happens. So the hokey analogy we've discussed before, if you're worried about houses burning down in fires, you first of all try to have good building codes and ensure good electrical wiring and make sure people don't smoke cigarettes when they're falling asleep. But sometimes they're going to be fires. So you also need a fire department, for those cases when, despite your best. So Dodd-Frank tries, and the goal is to enhance the prevention. So things like, going back to the very beginning, one of the underlying problems was banks had low levels of capital, low levels of equity. So there are higher capital requirements. The idea being that there'll be a bigger margin for error of money to lose before you become insolvent and people lose confidence. There are other different restrictions. I mean, you're right. I mean, in any area of regulation, whether it's financial regulation, environmental regulation, anything, it's a balancing act between protecting the world from whatever dangers versus restricting industry, and the devil's in the details as far as exactly what environmental regulations or what. I tend to be, in the case of finance, sort of on the side of erring on the over-regulating side, just that we've seen how catastrophic a financial crisis is. If you tell me there's some inefficiencies caused by regulation. In any case, though, the other part of Dodd-Frank is quite unfortunate, that it actually restricted the Fed's ability to serve as lender of last resort. So there are now, since Dodd-Frank, several new conditions before the Fed can lend, including under the law, it is now required that the Fed get the approval of the Treasury Secretary. So they don't have a choice anymore about that. There are other restrictions that are a little technical about what types of loans they're allowed to make or not make that might have made it harder to deal with the kinds of things that happened in 2008. And that, in my opinion, is unambiguously a step in the wrong direction. And actually, Bernanke and Geithner and Paulson have made the point that the Dodd-Frank Act goes in the wrong direction, tying our hands somewhat in dealing with future crises. And when I hear them say that again and again, I, on the one hand, agree 100%. But on the other hand, it's, from my point of view, a little ironic, since when they had the tools, they didn't use them at the most important moment. And so if I were granted one wish of changing one part of the Dodd-Frank Act, it would be taking away the new restrictions on Fed lending. I mean, in practice, lots of parts of the Dodd-Frank are in the process of being repealed, and that's not one of them. But
let's open up for some questions. I think Ehud had a question, and there's a couple over here already waiting.
Let me expand on that a little bit. I guess I want to understand why they weren't able to lend them, since it was collateralized. But the other issue is, why did the banks hold on to so much of the securitization there? Why didn't they just securitize it as quickly as they could? Maybe they did, and they ended up holding it, notwithstanding the desire to securitize.
Okay, so that's a good question. Why were the investment banks holding on to all these real estate assets that turned? So actually, part of it was starting like around beginning of 2007, they started thinking we're overexposed to real estate and trying to sell off the assets. But they were illiquid assets, which means by definition, they were hard to sell quickly for a good price. And they were, so Lehman actually Lehman was issuing reports about our illiquid assets have gone down from this to this, from this to this, just be a little patient, we're on the right course. I think though, initially, they, like everybody else, was sort of, caught up in the irrational exuberance of thinking real estate was a great investment and that they were going to make lots and lots of money. And actually, Lehman Brothers, I think Lehman Brothers cut back a little bit later than some. So there was a key point in 2006 when some people were already saying we have to cut back on real estate, and you can read the board of directors meeting. The management says this is a great opportunity. There's this disruption in real estate markets, and prices are artificially depressed. If we buy now, we'll really make a lot of money when things go back to normal.
Buy the dip strategy, right?
And I guess maybe buying the dip doesn't work if the
dip is a big one.
Um,
And going back to my first question, the issue of why weren't they able to do the repurchase?
Okay, so that is a puzzle. So a reason the whole crisis was so surprising to a large degree was that the whole idea of repurchase agreement. So early on, investment banks could not stop being able to issue commercial paper. Commercial paper means unsecured. I just get your money, promise to pay you back. If I go bankrupt, you don't get paid back. The idea of repurchase agreements is there's collateral. So, and if I lend you $100, you give me a security worth $105. So why do I care if you go? So people were surprised when first initially with Bear Stearns. We discussed this in the talk this morning. People give sort of funny, vague answers of, oh, it's awkward to liquid, it's bothersome or awkward to seize collateral and liquidate it. There's some of the lenders were actually money market mutual funds, which weren't allowed to hold the assets and might have had to sell it quickly. And what I think is maybe most important, and this was expressed in an internal memo at the Fed, somebody saying, I called up somebody at Fidelity Funds, I'm making up which counterparty, they were one of the big, and I said, why are you cutting off repos of Lehman? That's crazy. You're over collateralized. You're causing this big problem for no reason. And the guy who worked on the repo desk, which is somewhere in the middle of this big financial institution, said, oh, look, you understand repurchase agreements. You know it's not risky. I know it's not risky. I keep getting calls from my client saying, I hear you're lending money to Lehman Brothers. They're about to go bankrupt. I keep getting calls from my boss saying, I hear you're lending money to Lehman Brothers. What are you doing? And rather than try to explain that, apparently the repo market is very flexible, and you can stop on one day doing repos of Lehman and do them with Goldman Sachs, and that was just sort of the path of least resistance. That's the best I can do. And again, that sort of reinforces the role of the Fed to sort of keep their cool, and given that there really isn't any cost, they should step in and take over.
So an instrument that you see sometimes applied in banking crises is a bank holiday. So you say, we're closing the banks, maybe we'll have the chat like in the movie, at the business school.
Mm-hmm, mm-hmm.
So I'm just curious, so in this case, was it the possibility just, legally to sort of freeze things for a day or two to find an alternative buyer or some alternative solution? Or that was completely out of the table or was just impractical? And also going to the Dodd-Frank, has that changed or not? I don't know if you could, what you thought of it.
So it's a good question. I am pretty sure that would not have been legal. I mean, if the government or the Federal Reserve had said nobody has to pay back repurchase agreements due on Monday until Wednesday, that would have mean generally the government can't just come in and change the terms of contracts like that. Actually, it leads me to think somebody might know the history of Franklin Roosevelt's bank holiday and whether that was legal or, but I think
Probably not.
probably not. Yeah.
That's my guess with FDR.
So that was never, for better or for worse, it was never considered. I imagine people might think that would really, that could go either way. That could really spook markets if all of a sudden.
Wasn't a complication though that they had money to be paid in London at 9 a.m. on Monday, right? So you have to stop the system here and there as well. So that might have complicated things even further.
Yeah.
So the lawyer for the New York Fed before the FCIC that said that what was needed was a naked guarantee of all of Lehman's trading obligations, and that was why they couldn't loan the money, because that's like an unknown amount. So I was wondering if you could elaborate on what you think the New York Fed's argument is, and kind of at a larger point, let's say that they had used the PDCF to loan Lehman Holding Company the money and not just the Lehman broker-dealer. What happens on Monday? Like, is it just we're 2 days to try to find another buyer to hope that the Barclays shareholders can vote to guarantee the trading positions and then that deal goes through? Is it just an extension of a week so we can have a more orderly bankruptcy? Or is it Lehman Brothers is operating today and was never bought, and kind of like Goldman Sachs and Morgan Stanley?
Okay, so that's 2 or 3 great questions. Let me see if I can get them all, and you can remind me. So that's right. So so the general counsel of the New York Fed, Thomas Baxter, has said a lot of things that just don't make any sense. And it's one way to put it. It's just, I can give some examples. And so one of them was Lehman needed a naked guarantee, meaning a guarantee of any money they needed to pay. And by definition, there's not enough collateral to back a loan of infinity, so it was not legal to do that. He's right that it was not legal to have an unlimited loan, but what Lehman needed was a loan of a finite amount. If Lehman had brought $90 billion of collateral, they needed to lend them $85 billion. So that just is not that's off base about the naked guarantee. So what would have happened? So as far as so there are always complexities about. There was the holding company that declared bankruptcy. There was the broker-dealer in New York, the broker-dealer in London, and they actually did lend some money to the broker-dealer in New York. This is not very well known. They actually lent, while saying we're not having a bailout, they lent $28 billion to keep the New York broker-dealer going. They would not lend to the London broker-dealer. So what needed to happen was either they lent to both the New York and London broker-dealers, or they lent to the New York broker-dealer enough to transfer cash to the London broker-dealer, because that kind of inter-Lehman exchange happened all the time. And again, there are all sorts of, we could spend a long time on the details. Basically, the Fed made that impossible. If both the broker-dealers had gotten cash to operate, they could have. I think the time scale, weeks to months to maybe a year, sometime where they could have tried to figure out something, and three things could have happened. One is they could have eventually gotten the Barclays deal through. The second is that didn't work, but Lehman was able, like AIG, like lots of firms, to do some restructuring, to maybe raise some capital to survive. The third is that didn't work, and Lehman ultimately, like, say, long-term capital management, had to be wound down. But as I discussed in the book, even in that case, having a wind down over a period of months where they can sell assets, close out contracts would have been much less disruptive. I think there were a couple of law professors this morning who backed me up on this, that the idea of telling a corporation you have to file the biggest bankruptcy petition in U.S. history by a large margin, and you have 6 hours to do the bankruptcy petition is just like science fiction. So it accounts for how disorder. So buying time would have made a big difference. Actually, Ben Bernanke, in his memoir, has, I think, an interesting passage in which he talks about one of Lehman's strategic plans, which was, you hear the jargon about a good bank and a bad bank. Lehman was going to spin off its bad assets, get different investors. And Bernanke actually says, that kind of scheme works sometimes. That wasn't a crazy idea, but then he dismisses it. He says, well, obviously they didn't have time to implement that. They were about to go bankrupt the next day. But the reason they didn't have time to implement it was that the Fed wouldn't provide the loan.
So Barclays ultimately did acquire a lot of the assets of Lehman Brothers in just fire sale. Contrast that with JP that buys Bear Stearns outright in WAMU. Barclays comes out pretty well. JP Morgan gets a $13 billion lawsuit over the prior actions of WAMU and Bear Stearns. If in a future scenario like this, could you talk about how that might create some perverse incentives and why maybe the crop rate, why they should have bailed out Lehman in the first place?
Oh, that's interesting. Because, so the background, right, I think Barclays decided they didn't really want all of Lehman Brothers. Basically, Barclays wanted to expand. So they've expanded into New York in the north, so why the Brooklyn Nets plays in the Barclays Center as part of their whole. So they wanted to buy the broker-dealer. And they sort of were reluctantly willing to buy the rest of Lehman if some of the assets were taken off the balance sheet. This was not at all planned, but I think it actually ended up working, beautifully for them in the sense that after Lehman, after the holding company went bankrupt, they were able to buy from the bankruptcy estate the broker-dealer, the part of Lehman they actually wanted, and they bought it for essentially nothing. And some of the creditors said you can't sell this off to the valuable asset. And the bankruptcy judge basically said, if they don't sell it off now, the financial system is collapsing. So they did very well. As far as, yeah, so I mean, actually, if Barclays had strategized to make it work out that way, it would have been a brilliant strategy. But it was actually accidental.
I had a question on the BAML merger. Earlier, you kind of described that as Merrill Lynch kind of got ahead of everything and selling to Bank of America. There's a million different pieces online about Bank of America. Once I kind of found out what was in Merrill Lynch, kind of, and instead of being a happy marriage, it's kind of a shotgun wedding by Paulson. So really just kind of curious what you thought political difference between that and Lehman was, if you had any opinions on the subject.
So I don't know a lot about this, although actually I have one old classmate from graduate school who worked for Bank of America who I talked to. My understanding is that the Bank of America thought that Merrill Lynch was a better, a more interesting acquisition, and that so now if you go into a Bank of America branch, it says, oh, while you're here depositing your check, why not stop by our Merrill Lynch brokers to set up your brokerage account? That they wanted that part of the business as an acquisition. So they were very reluctant to buy Lehman, but sort of jumped at the opportunity to buy Merrill. And then after that, there were controversies about what were they buying. And
so in your three scenarios you just laid out and kind of really just stockets, how do you see that third scenario playing out differently than what kind of happened? I mean, it sounds like the two would have been somewhat the same, but maybe less of a time crunch. In that Barclays kind of stumbled into a good situation on their end, but if Lehman was in that position and they weren't able to sell themselves and they weren't able to restructure and they ultimately had to sell bits and pieces, how do you see that would have been different than what ultimately happened?
So a couple of specific things that would have been different. So Lehman, in the immediate aftermath of the bankruptcy, lost about $75 billion on derivatives contracts. And the details here are there's so many complex things. I can understand really only actually a chunk of it, but my understanding, I mean, how bankruptcy law treats derivatives is a whole field, that when Lehman Brothers went bankrupt, they were in default on their derivatives contracts. And then the counterparty has the option to close out or not close out the derivative contracts, and there are issues about the bid price, the ask price, this and that. It's all in the favor of the counterparty. So Lehman just lost, and the notional value of Lehman's derivatives, I believe, was $35 trillion. So you don't need too much difference between bid and ask prices on a second. So that was for Lehman. In general, so one specific effect of the Lehman failure was the fact that Lehman then defaulted on its commercial paper, and one money market mutual fund, the reserve primary fund, lost money and, to use the jargon, broke the buck, where suddenly if you had a $1 share, it was only worth 97 cents. And that led to a run on the money market funds and then problems issuing commercial paper by companies. More generally, just the panic of it happening so quickly.
So essentially time could have just dealt them a better hand.
Time could have led to more. Actually, so Alan Greenspan, somebody quoted me, I think this is pretty close. So this, a lot of this is not new idea. Alan Greenspan, I think, once said, no institution is too big to fail. Some institutions are too big to liquidate quickly, and without chaos. And that was the issue.
Larry, any idea why they are doubling down on the official explanation that it was like an sound economic reasoning was behind the decision of not to rescue Lehman Brothers, where there's some evidence at least that suggests that was not the case? Why are they doubling down? It's not like Bernanke's thinking, I want to be reelected as chairman of the Fed or something like that.
I don't know, and I wish some Fed officials were here so we could. I'd like to ask them too. I don't have anything better than just once people adopt a position and say this is why we did something. They don't want to say, oh, you've explained why what I said is wrong. Thank you. That's very helpful. They tend to stick with their position. I don't. It's not
Especially
a very.
once you've lied to Congress.
Right. That's a question here on a specific that I think sort of sheds light to the whole idea of the sort of fake notion that we have, I'll call it bailouts versus lending that was needed for liquidity. So you say the $69 billion are given to Goldman Sachs through the PDCF and 107 to Morgan Stanley. Those are all collateral. How do I say it?
Collateralized.
Right. Under new collateral that was now allowed to be given to that program, which up to September 14 was not allowed, right? So they expanded what they would take. They took on more riskier stuff, right? They lend money in that program to both Goldman Sachs and Morgan Stanley. What was the loan? What was the loss to the taxpayer of those two loans?
None. Actually, Fed officials and Treasury are fond of saying the losses in any of the program, they got paid back on everything. But that's a little, of course, just because a gamble, because you went to the casino and you won some money doesn't mean it was smart. So there's a distinction in some cases actually Bear Stearns and AIG, I think it was something of a gamble. That if the financial crisis had gone from bad to worse, they could have, and actually, if you can look at the balance sheet for Maiden Lane, they were underwater for a while when the assets depreciated, and eventually it recovered. The lending through the PDCF was actually not even risky in the first place because it was a day at a time with more than 100% collateral. Even with the world collapsing, there just wasn't any risk.
Well, the collateral could go away. They could disappear somehow. Part of the collateral could become, bond, whatever. Some bond. So let's say some of the collateral is treasuries. Maybe treasury would default. There's a weird state of the world where the collateral would go bad, right? So there was some risk potential. That's why you have a haircut, but none of this actually materialized, right?
Yeah, and it's a pretty certainly, if I lend you money to be paid back tomorrow with treasury securities as collateral, the chance that the U.S. government would default between now and then is not.
It's not very high.
large.
That's right.
It's right hard, but not that hard.
That's right.
One question, if the PDCF should have applied to Lehman and they weren't allowed to use it, but other banks were, could Lehman shareholders sue the government?
Now that's interesting.
That's why the Fed sticks to their guns?
That's interesting because, of course, some AIG shareholders did sue the government, ultimately unsuccessfully, saying that the government imposed overly harsh terms in the AIG rescue. The short answer is I don't know whether. I think the Fed was sort of arbitrary in who they lent to and didn't lend to, and that was.
But even if it shouldn't been a political decision, it's just this thing set up that is there. If Lehman has collateral, they can come and use it, and they were told they couldn't use it, so the law applied differently to them versus the other banks. So then you can say that that's violating.
The little I understand about suing the federal government is really difficult. Number one. Number two is that they had the law says something that was never litigated was the satisfactory. They had to be show satisfactory, and it's always going to be very murky, and I think that would be very hard to win such a lawsuit. I don't know. That's my read of it.
I actually can't resist saying. Actually, I have experience suing the Federal Reserve in federal court because under the Freedom of Information Act to try to get some documents, and found out it's pretty. They have a lot of good lawyers, and.
Derek, I'm going to ask you, my understanding is that the salvage value of Lehman bonds was very low, like 5-7 cents on the dollar. So there must have been a lot of degradation in value. Can you speak a little bit to what happened to those assets?
Right. So 5 to 7% is way low. It's more like 50%. But still 50% of $300 trillion, is a substantial loss. So that actually is something I don't fully understand. So everybody talks about the bankruptcy process was chaotic. There are these stories about the people, the bankruptcy estate show up and the computer systems aren't working. Sort of exactly where all the losses were. I actually talked to, so the bankruptcy proceedings are still going on. I had lunch a few weeks ago with some lawyers who work for the bankruptcy estate. And actually their version is that they're actually that they were treated unfavorably by the courts. Their second biggest villain after the Federal Reserve is J.P. Morgan Chase, who they say seized a bunch of collateral and made up flimsy excuses, and some lame-brained judge agreed with that. Somehow in the bankruptcy process, but I don't fully understand that.
Given the pressures of time and regulatory risk, I was just startled that they were working with Barclays versus an American bank to engineer a takeover. How did Barclays say versus Citibank get in the lead role of trying to save Lehman? How did that happen?
They were willing. So actually, over the 6 months between Bear Stearns and Lehman, basically Henry Paulson tried to broker an acquisition, and he actually talked to Citi. Basically, this is all documented in the Bankruptcy Examiner's report. Basically, they talked to every single global investment bank, every sovereign wealth fund. They called up Warren Buffett. They called up Carlos Slim, various people, and nothing. One thing, so I have not looked at this carefully, but here, sort of what Fed officials and Treasury Secretary Paulson say, it kind of rings true to me, that Richard Fuld was a little unrealistic in thinking about how much. So he said to all these people, sure, let's negotiate an equity stake, but then the price was too high. Barclays, I guess, was sort of in the right place at the right time. They were not very involved over the summer. Bob Diamond, the CEO, had actually said, "Oh, it's not so clear. It's a good match. Our businesses overlap, but we would maybe buy them," in his words, at a very, very distressed price. And suddenly they found themselves as the last person standing when they could buy them for almost nothing.
Throughout your research, have you come to realize that maybe there is one player, perhaps a product that you think is most in line with causing the crisis? For example, was it more investment bankers or mortgage brokers or rating agencies? Is there one person who you think caused the crisis more than others?
So that's a great question. Whose fault is it? And also, who, if anybody, should have been locked up? I'm on the side that it's basically everybody's fault. What were people doing buying houses for 8 times their income, what in the world were mortgage lenders doing making those loans? What were securitizers doing? Actually, I've seen, there was all sorts of, what were the lawyers for the banks doing, reviewing the securitization documents? What were regulators doing, allowing this to happen? What was the economics profession doing? There were a few sort of isolated voices talking about, oh, there's a bubble, there's going to be a crisis, but sort of nobody. And again, in hindsight, it seems, and maybe a little more is sort of everything. If house prices had just nationally kept going up or not fallen, actually things would have been okay, because basically, as long as the price, underlying it all was defaults on mortgages. And as long as your house price is going up, it's hard to default on your mortgage, because you can, first of all, if you need money, you can get a home equity loan. If you really think I'm in over my head, you can sell your house and make a tidy profit. It was only when house prices started to fall. So why anybody, actually, Alan Greenspan, I have a quote from 2005, I think, where he sort of patiently explained this is all overblown. We've seen there have been real estate booms and busts in different parts of the country. So Texas in the 1980s, New England in the 1990s, real estate prices have fallen. But in such a large, diversified economy, the chance that aggregate house prices would fall. This is worth. And there was all this very sophisticated risk analysis by both regulators and investment banks. So they put all these numbers and all these complicated models and did these state-of-the-art calibrations. But underlying it all, they were using data in which the percentage of time national house prices went down was 0. So that got the result that this is really very safe.
To follow on to that gentleman's question, though, a lot of those mortgage holders had teaser rates on 1-year ARMs. And so how could have the big banks risk management departments miss what happens when these come up for refinance. Because even if house prices had stayed up, if the interest rate goes way up, they're still not going to be able to afford to refinance. Or am I missing something?
No, I don't think you're missing anything. I think people somehow just got caught up in irrational exuberance, to use Schiller's term. And there are the rating agencies. Why were the rating agencies giving? I mean, there are stories about investment banks or rating agencies where some person, some mid to low level person writes a memo to the boss saying, "Oh, this real estate thing is getting, we have to cut back on real estate," and the boss says, "What, you want to keep your job? You're talking, why don't you write memos to McDonald's saying we should get rid of the Big Mac?" It was just, that was how you were making money, and it.
But Larry, there seems to be not your story, but if we're only telling that part of the story, it seems to be an incomplete part of the story, because it may suggest to some extent that it was greed that drove bad behavior on all these actors, the ratings, the home buyers, the regulators, the lending banking, all that stuff, and that is perhaps true, but there is greed in other industries, right? And we don't see this huge crisis is unfolding in other industries. So there's the other part that you actually discuss in that book, which is and others have done, that the regulation environment surrounding, the incentive structure surrounding and funneling greed in certain ways that were not compatible with a sustainable situation. Is that a fair characterization, or?
I think so, certainly. Or I don't know whether greed is a polite word to. There were some opportunities to make profits, which is economic textbooks say firms pursue. There is a whole question of were they unethical, illegal. We can come back to that, but yeah, it was a failure. I mean, I think ultimately, we need financial regulation, because if I start a restaurant and I'm the worst cook in the world and the restaurant closes down, maybe a couple people are annoyed they've had bad meals, but it's mainly my problem. If a bank fails, it has big effects on the economy. So we need we need strong financial regulation, I think.
So I might jump in there and talking. So as far as who to blame, there's another book that's out long ago, Peter Wallison, who was on the financial crisis.
Yes.
And he's much more specific at who to blame. And I think what his story comes down to is, well, if you look at what the regulators were doing, it wasn't that they were allowing this to happen, but it was that they were encouraging it to happen. The primary focus of regulation, at least in his story, leading up to the financial crisis, was getting underwriting standards down. So
So I recommend the final report of the Financial Crisis Inquiry Commission, which is not that well known, but which it actually has a chapter on each, a chapter on Bear Stearns, a chapter on Lehman, a chapter on AIG, and it's really a very good. It's quite readable, but also much more sophisticated than the Wall Street Journal or something. So you should all read the history there. But when you do that, I recommend skipping. I read the staff report. I would skip the majority report of the commissioners and the minority report, because they're total political boilerplate. Basically, the majority was Democrats, and they said the problem was there was not enough financial regulation, and people got out of control. We need more regulation. So Peter Wallison from the Conservative American Enterprise Institute was on the minority. He said, well, obviously this proves there was too much regulation, and the government did intervene. There was the issue of should Fannie and Freddie buy subprime mortgages because they're taken out by low-income people. Low-income people should own houses too.
But he was pretty quantitative about his analysis. I mean, I found the book was fairly careful.
Okay, although I think other people, in a sense, actually, it wasn't just the subprime mortgages. It was people buying vacation homes and rental. I doubt. I don't know. We can talk about who gets 18% of the blame and who gets 14% of the blame, but there were a lot of people who get some of the blame, I think.
Does that report say who should go to jail?
No, it does not. It does not say who to go to jail. So that's. So there's a question of were there. So let's leave aside sort of what's ethical or fair or greedy. were there violations of federal law? That is not clear. And actually, I've actually talked to lawyers about this. I'm not that well informed, but the kinds of things that maybe could have been prosecuted were investment banks making misleading statements about, oh, we don't have so much exposure to subprime mortgages, when really they did. But apparently that, there are gray areas. Basically, people, so even if we reintroduce the term greedy, there's no law against being greedy. There's no law against, foolishly, betting on things you shouldn't bet on. We can argue different kinds of culpability, but it's not crystal clear that there were legal violations. And again, there's a lot to be said on both sides. One argument I find is actually there were, and people, on the one hand, people on Wall Street are pretty politically connected, so some people point to that. On the other hand, there are, you would think, U.S. attorneys who are ambitious and could advance their careers by being the ones who, put these bad guys in jail, and they didn't do that.
All right, let's close it up, and I'll give you the last word on two things. Moving ahead, from what you learned, what are the two things you would potentially change, and so that hopefully next time is not as bad or a little better?
Certainly changing the Dodd-Frank Act back and allowing the Fed to be a lender of last resort, and making sure that whoever's running the Fed understands that that's their most important job. And then generally strengthening financial regulation.
In a particular way, or anything that?
I tend to think higher capital requirements are kind of a robust, there are an infinite number of things you could do to lose money, but whatever reason you lose money, if you have a capital buffer, that helps. And, there are arguments about, that could make some intermediation more expensive. There could be some costs, but again, reducing the chance of having 2008 happen again would be worth a lot.
All right, with that, let's thank our guest again.
Thank you all.